So have you ever wondered what actually drives the massive profit engines of modern healthcare companies?
Oh, that's a great question. Because we always tend to just look at the surface level stuff.
Yeah, exactly. Like we think it's all just selling medicine or booking surgeries.
Mm.
But underneath all that clinical care, there is this incredibly complex web of, well, real estate maneuvering, institutional negotiations, and just heavy financial strategy.
Right. From a corporate standpoint, they're these highly orchestrated economic ecosystems. The clinical work is really just the catalyst for a much, much larger financial operation.
And that's exactly our mission for today's deep dive. We're going to crack open the 2025 consolidated financial statements of Mouwasat Medical Services Company.
Which is such a fascinating document, honestly, because it forces you to look past the stethoscopes and actually see the business model underneath.
Exactly. So we're going to break down for you exactly what products and services they sell, who their true customers actually are, and the exact drivers behind their massive leap in profitability from 2024 to 2025.
And that jump in net profit is really the central mystery here. I mean, they posted a nearly 30% increase in a single year.
30%, that's huge.
It's massive. And for a mature, established company, a leap like that rarely just comes from, seeing more patients. It requires pulling some very specific, often kind of hidden levers in the background.
Right. So to understand how they pulled those levers, we have to look at what they're actually selling first. Because their operations are basically split into two distinct revenue engines.
Yeah. Think of it as a sprawling healthcare ecosystem rather than just a single hospital. So engine number one is medical services.
Okay.
And this is the heavy lifter. It encompasses both inpatient and outpatient services across all their multiple branches and subsidiaries.
Like Eastern Medical Services and the Jeddah Doctor Company. Right?
Exactly, yeah. And this segment alone, just this one, generated 2.735 billion reals in 2025.
Wow. Over 2.7 billion. Okay, so what's the second engine?
So engine number two is pharmaceuticals. This is the drugstores, the pharmacies, the wholesale medical equipment, and drugs. And in 2025, that side generated about 486.6 million reals.
This dual engine model, it really reminds me of how an international airport operates.
Oh, that's a good analogy. How so?
Well, like an airport doesn't make all its money just by charging airlines to land planes, right?
Yep.
That's the medical services, the big ticket surgeries and consultations.
Right.
But the airport makes an absolute killing by owning the duty-free shops, The magazine stands, the restaurants inside the terminal, that's their pharmacy segment.
Yeah, that's spot on. You go to Mouwasat for the doctor's visit, but you stop at their internal pharmacy on the way out to fill the prescription. They're basically capturing revenue at multiple points in your journey.
Right. But looking at the report, it mentions different timings for how they recognize this revenue.
Right.
How does a business actually book cash that's coming in from so many different places?
Well, the accounting behind those touch points is actually really revealing. So they follow the IFRS, the International Financial Reporting Standards.
The global rule book for counting corporate money, basically.
Exactly. And under those rules, they have to separate revenue recognized at a point in time from revenue recognized over time.
Okay, let's translate that out of accountant speak for everyone. I assume at a point in time is like the pharmacy, right?
You got it. You buy the medication, you walk out, the transaction is totally complete. The hospital logs the cash immediately.
Nice and simple.
Yeah, and that point in time bucket accounted for roughly 1.8 billion rials of their revenue. But the inpatient services, those are entirely different.
You're there for a while.
Exactly. If you're admitted for a 5-day stay, they are providing a service to you continuously over those 5 days. They can't bill it all in one split second before you've received the care.
Right, because they haven't finished providing the service until you actually leave the building. So that's the overtime revenue. Okay, but what happens if I'm on, say, day 3 of my 5-day hospital stay, and it happens to be December 31st? Like, the accountants need to close the books for the year, but my medical service isn't finished yet.
Oh, that is exactly where it gets tricky. So the finance department creates what is called a contract asset.
A contract asset. Okay.
Yeah, it represents unbilled revenue for services that have been rendered to patients who haven't been discharged yet. You've consumed the bed space, the nursing hours, the IV drips up to that date.
So Mouwasat has definitely earned that money.
Right, they just haven't generated the final invoice yet. And at the end of 2025, they had about 5.8 million reals just sitting in these contract assets.
Wow, 5.8 million. That really paints a picture of a machine that just never stops.
Mhm.
But, they aren't just operating the hospitals they already have.
No, not at all.
Yeah, digging into their property and equipment notes, they operate almost like a commercial real estate and construction entity. In 2025 alone, they capitalized 52.4 million reals for construction work in progress.
Yeah, and just to clarify that terminology for you guys, capitalizing means instead of taking that 52 million as an immediate expense that hurts this year's profits, they record it as an asset on the balance sheet.
Right, because they are building a physical structure that's going to hold value for decades.
Exactly. They are aggressively laying concrete. I mean, they launched a brand new hospital in Yanbu right after the 2025 financial year ended on February 1st, 2026.
And simultaneously, they signed a 20 to 30-year land lease for another new hospital in Jubail. Like, this is a highly expansionist model. They are locking down massive physical footprints for the long haul.
They really are.
So, okay, they're building these massive physical hospitals. They're dispensing hundreds of millions in pharmaceuticals. But concrete and steel aren't cheap, right? So the next logical question is, who is actually paying the bills?
Yeah, who is generating the revenue to fund this empire?
Right. Because you naturally assume it's, well, you and me. The individual patient walking through the front door.
Right, but while the individuals receive the medical care, the actual financial customers, the entities actually cutting the checks, are massive institutions.
And the numbers on this are just wild.
Oh, it's staggering. A full 96.3% of the company's accounts receivable in 2025 was due from governmental entities and insurance companies.
Wait, 96%?
Yep, 96.3 to be exact.
Having almost all of your owed money tied up with the government and massive insurance conglomerates.
Yeah.
I mean, that seems like a terrifying concentration of risk.
It's just a massive risk.
Like, if you are relying on a handful of massive entities to pay the bills, you are completely at their mercy if they decide to dispute a batch of invoices or delay a payment cycle. What happens then?
Well, this is the central tension of their entire business model.
Yeah.
When you deal with massive institutions, you aren't just swiping a credit card. It is a continuous, really heavy negotiation.
Okay, so how do they manage that?
The accounting term for how they handled this is variable consideration.
Variable consideration. Okay, so if you're listening and you've ever stared at a confusing medical bill and wondered why the price the hospital charged looks completely different from the price your insurance actually paid, this is variable consideration in action, right?
Exactly. That's a perfect example. The hospital sends an invoice, but they know they aren't getting that full amount.
They just assume they'll get less.
They know it with absolute certainty because the insurers and government agencies have armies of auditors and algorithms. They might adjust a claim for a technical error in the paperwork or dispute the medical necessity of a specific MRI.
So Mouwasat has to forecast how much of that massive invoice will actually clear, just based on historical data.
Right. But an even bigger factor driving this is retrospective volume discounts.
Which is kind of like a corporate loyalty program, right?
Yeah, basically.
Like Mouwasat tells a major third-party payer, hey, if you direct 10,000 patients to our hospitals this year, we will retroactively give you a 5% discount on the rates.
Exactly. And that forces Mouwasat to book revenue while simultaneously estimating the discount they will eventually have to hand back at the end of the year.
Which is wild to think about.
It really is. And we can see the exact cost of those negotiations in the balance sheet under a line item called refund liability.
Right.
This represents the estimated discounts and adjustments they owe back to these big payers. In 2024, that liability was about 156 million rials. And by 2025, it jumped to 179 million rials.
Wow. An SR 179 million liability just sitting there. That basically proves that negotiating these massive, complex volume deals is the core feature of their business. They're factoring in estimated discounts before the money even clears the bank.
Oh, absolutely. So let's look at how that actually translated to the 2025 bottom line, because this is where that 30% profit leap happens.
Right, the big mystery we started with.
Right. So in 2024, they posted a net profit of 669.6 million rials. But in 2025, that skyrocketed to 852 million rials.
Which is just a massive increase. And the most obvious driver is simply top-line growth, right? They just brought in a lot more money overall.
Yeah, total revenue grew by roughly 343 million rials year over year. It climbed from 2.879 billion to 3.22 billion.
So both the medical services and the pharmaceutical segments saw really strong growth. And that resulted in a gross profit increase of over 124 million rials.
The top line grew, sure, but we have to remember, treating more patients inevitably costs more money.
Yeah, it's like, let's use a restaurant analogy. Say you run a steakhouse and you have a banner year. You sold 20% more steaks than last year. Your revenue is completely through the roof.
Sounds great so far.
Right. But to sell 20% more steaks, you had to buy 20% more meat from the butcher. You had to hire more waiters to serve the extra tables. You had to pay more for electricity to keep the grills running, you know.
Exactly, and we see that exact dynamic in Mouwasat's cost of operations. Their employee costs, so the doctors, the nurses, the administrative staff, that jumped from 658 million to 742 million reals.
That's a huge jump in payroll.
It is. And material consumption, which is primarily medical supplies and drugs, that jumped by about 55 million reals too.
Okay, so because top-line growth comes with all these expensive associated costs, simply seeing more patients doesn't fully explain how the net profit jumped so drastically from 669 million to 852 million.
No, it doesn't.
The real story isn't happening in the operating rooms. It's buried in the finance and accounting adjustments, isn't it?
Oh, 100%. The income statement reveals a line item that completely swings the narrative. It's called impairment loss on accounts receivable.
Okay, break that down for us. What does that mean?
Basically, this represents the company writing off bad debt money they assume they will never, ever collect. In 2024, the company took a massive hit here. They provisioned 78.4 million rials for debts they basically just gave up on.
Wow. 78 million. That must have acted as a huge anchor on their 2024 profits.
Oh, it dragged them down hard. Taking a near 80 million rial loss is painful, but the story flips entirely in 2025.
What happened?
They didn't just avoid another huge loss, they actually recorded a reversal of impairment, a gain of 9.8 million rial.
Wait, a reversal. So they collected on old debts they had previously written off, or they reevaluated their outstanding invoices and realized the debt was, like, much safer than they originally thought.
Exactly, both of those things, potentially.
That is fascinating from a business reality perspective. Because in healthcare, bad debt rarely means like an individual patient skipping out on a bill, right? Given that 96% of their revenue is B2B, this likely means they were locked in some multi-year dispute over coding or claims with a national health service or a massive insurer.
That's the most likely scenario, yeah.
So getting a reversal means they finally won the dispute, or they negotiated a massive settlement on a backlog of old claims. It's literally like taking a corporate partner to arbitration over a forgotten contract and suddenly winning a huge payout.
And the math on that outcome is just staggering. Think about it. If you take a 78.4 million loss one year and then have a 9.8 million gain the next year.
That is an 88 million rial favorable swing to the bottom line.
Exactly.
And the beauty of that 88 million rial swing is that they got it without having to treat a single extra patient. There are no extra doctors to hire, no medical supplies to buy. The cost of goods sold on that recovered debt is literally zero. It falls straight to the bottom line.
It's pure profit. But that's not the only financial lever they pulled. Their treasury and finance teams also executed a highly optimized cash strategy in 2025.
Ooh. What did they do?
Look at their interest income. They had cash sitting in term deposits, and the interest they earned on that doubled, jumping from 11.9 million to 22.4 million reals.
Right, because the macroeconomic context is so crucial here. With central bank interest rates staying elevated, corporate cash isn't just sitting idle anymore. If you have hundreds of millions in reserves, high interest rates mean that cash generates serious yield.
Yep. And while earning more on their deposits, they simultaneously slashed their own borrowing costs. Their finance costs, the interest they pay on their own loans, dropped from 30.4 million down to 19.5 million reals.
That's a huge drop. How did they pull that off?
The cash flow statement shows they proactively paid down over 210 million reals in long-term loans during the year.
Oh, that is classic balance sheet optimization right there. If the cost of capital is high, you just use your strong operational cash flow to retire expensive debt, immediately shedding that interest burden.
It's brilliant. And there is one final piece to the 2024 comparison, too. In 2024, they suffered a 10.6 million real loss on the sale of an associate company called AMPC.
Okay, so a one-time drag.
Exactly. And in 2025, that loss just disappeared. So when you combine the 88 million impairment swing, the doubled interest income, the reduced debt burden, and the absence of that AMPC loss,
You suddenly see exactly how that net profit jumped by nearly 30%.
all without even needing to look at the patient numbers.
It really highlights how much of a modern healthcare company's success is dictated by the finance department. And I want to push back on this perfect picture for a
Okay,
second,
go for it.
because there is one specific exploding cost buried in their general and admin expenses that kind of challenges this whole narrative of perfect optimization. I noticed the NPHIE's fee accrual,
Ah, yes, the NPHIE's fee.
right? This is a unified electronic platform fee.
Yeah.
In 2024, it cost them 8.9 million rials, but in 2025, it jumped to 29.5 million. It more than tripled.
hmm
Why is their tech administrative cost suddenly exploding like that?
Well, this actually ties perfectly back to their customer base. NPHIES is the National Platform for Health and Insurance Exchange Services. It's this massive digital infrastructure mandated to streamline the exact institutional billing we were discussing earlier.
Oh, I see. So if 96% of your revenue comes from massive institutional payers, you really cannot rely on paper files and fragmented servers anymore.
No, not a chance. You need to be deeply, deeply integrated into the government's centralized systems.
Wow.
Heavy, costly integration into national electronic health platforms is simply well, it's the toll on the digital highway.
Right.
If you want to process billions of rials and insurance claims efficiently and, reduce those exact claim disputes that caused their bad debt in the past, you just have to pay the platform fees.
Makes sense.
So while it looks like an exploding cost on the spreadsheet, it's actually a mandatory investment in maintaining their pipeline to those institutional payers.
Because if you were going to run a billion-dollar institutional billing ecosystem, you literally have to pay for the enterprise software to run it.
Precisely.
Okay, let's summarize the mechanisms we've explored today. Because Mouwasat Medical Services is a clinical operation, yes. But fundamentally, it is a massive real estate developer and a highly sophisticated institutional billing ecosystem.
Exactly. The clinical excellence generates the raw activity, but the financial engineering dictates the actual profit. Their 2025 jump was driven by top-line patient growth, so both the medical and pharma engines firing, combined with a massive victory in institutional debt collection.
Right. They cleared the bad debt, aggressively optimized their financing by paying down those expensive loans, and capitalized on high interest rates with their cash reserve.
It was a masterclass in balance sheet management.
It really was. So I want to leave you listening with a final thought to ponder as you think about the future of this industry. We talked about how aggressively Mouwasat is expanding its physical footprint, right? They are locking down 30 to 40-year land leases to build massive brick-and-mortar hospitals, millions of rails capitalized into concrete and steel that will stand for decades.
Which is a massive bet on the permanence of centralized physical healthcare facilities.
But as we just saw with those exploding NPHIE's fees, the administrative and operational side of healthcare is becoming increasingly digital, it's virtualized, and it's integrated into national cloud platforms.
Very true.
Over the next 2 or 3 decades, as telemedicine, wearable health tracking, and remote AI diagnostics explode, the actual nature of a doctor's visit is going to fundamentally change. So the question is, will those massive physical land commitments in giant concrete buildings remain their greatest competitive advantage? Or, in a decentralized cloud-based medical future, will they become a heavy, immovable anchor?
It's a huge question for the entire sector.
It really is. Because no matter how brilliantly you optimize the balance sheet today, you still have to decide where to pour the concrete for tomorrow. Thank you for joining us on this deep dive.